Aotearoa, and welcome to Friday's Economy Watch, where we follow the economic events and trends that affect New Zealand. I'm David Chaston, and this is the international edition from interest.co.nz. And today we lead with news tankers in the Red Sea have been hit by missiles fired from Yemen. This is unnerving global markets today, and oil prices have jumped everywhere. Bond yields are surging, pushing up mortgage rates and weighing on equity valuations, especially for tech firms. But first in the US, there were 192,000 initial jobless claims last week, a notable drop and far lower than seasonal factors would have accounted for and lower than expected. There are now 1.85 million people on these benefits, also lower than a year ago, but actually an increase from a week ago, as claimants are staying on benefits longer, even if it is now much harder to get initially qualified. The Chicago Fed's National Activity Index came in slightly below trend, but enough to suggest the US economic expansion is still in place in June. But if the Atlanta Fed's GDP now tracking is to be believed, that expansion is at a modest level. Consensus forecasts are being trimmed too. The US Treasury 10-year TIPS yield of inflation-protected bonds jumped about 30 basis points today and back to highs we last saw in the pandemic and prior to that in the GFC. Canadian retail sales expanded in June, extending their positive track to 6 consecutive months. This was for both value and volume, to be 5.9% higher than year-ago levels. Canadian CPI is running at 2.8%. Across the Pacific, China's foreign direct investment rose $11 billion in June, better than expected and better than the $7.6 billion fall in the same month in 2025. Meanwhile, China's consumer trade and subsidy program is losing momentum as appliance and car demand weakens there. South Korea said its economic activity expanded an impressive 3.7% in the second quarter of 2026, almost the same as the 3.8% in the first quarter. This is their fastest expansion since the fourth quarter of 2021 and came in above market estimates of 3.5%. Strong exports were a key factor in this result. And Singapore's June CPI came in at 1.9% in June, and although that was the highest since August 2024, it was less than the 2% expected. And that was because there was no change from May. In India, we should keep an eye on youth protests because they are spreading and gaining surprisingly wide support. In Europe, and as many expected, the ECB left its key interest rates unchanged at its July meeting overnight, following the 25 basis point hike in June. Since then, policymakers have struck a more cautious tone, adopting a wait-and-see approach as softer inflation, wage growth and economic activity and inflation expectations have reduced the urgency for another move. But that may have changed today with the unexpectedly large spike in oil prices. But who knows how fast that may change again. Markets do anticipate another ECB rate hike in September, though. And staying in the EU, consumer sentiment improved in July. That is to say, it got less negative. And in a decision likely to intensify transatlantic trade tensions, European Union regulators overnight hit Google with an €890 million fine for illegally undercutting competition through its dominance in search. However, Google will not be hurt by this directly in the short term because it reported almost a $41 billion profits in the second quarter of 2026 alone. If it is hurt, it'll be from their heavy cash burn for its AI build-out. The Australian labour market grew surprisingly strongly in June, adding 76,000 new jobs, far better than the 15,000 expected. Their jobless rate was stable at 4.4%. More than half the new jobs were in New South Wales, with good gains also in Queensland and Western Australia, but Victoria shed jobs in the month. This overall strength will add spine to the RBA's fight against rising inflation, because they will now be less worried about a weak economy. The RBA next meets on August the 11th, just 17 days away. Global container freight rates fell 4% last week to be 74% higher than year-ago levels. Outbound rates from China were the basis of the pullback from the prior week. Bulk cargo rates were down 8% for the week, and these are now a third higher than year-ago levels. The US Treasury 10-year yield is now just on 4.70%, up 4 basis points from this time yesterday, and its highest since January 2025. Wall Street is 1.4% lower today on the S&P 500, with the Nasdaq down 2.5%. And the price of gold has fallen to $4,042 an ounce, down $98 from yesterday. Silver is now just on $57.50 an ounce, down $2.50 from yesterday. And oil prices are another $6 higher from yesterday at $93 in the US, while the international Brent price is just on $101.50 up $7. Hormuz transits are still just a trickle. There have been no crude tankers and 5 cargo ships exiting in the past 24 hours and 8 entering for new loads. The Red Sea is also now effectively blocked at Yemen, although a small handful of ships are still getting through. The Kiwi dollar is another 40 basis points lower from yesterday at just on 57.7 US cents. Against the Aussie, we're down 40 basis points at 82.8 Australian cents. Against the euro, we're down 30 basis points at just over 50.7 euro cents. That all means our trade-weighted index starts today at 60.6, which is down 40 basis points from yesterday too. And the Bitcoin price starts today at $64,762 and down 2.1% from yesterday. Volatility over the past 24 hours has been extreme, just on plus or minus 7%. You can get more news affecting the economy in New Zealand from interest.co.nz. Kia ora, I'm David Chaston, and we'll do this again on Monday.